Well, Fed Chair Jay Powell signaled a possibility of a prolonged pause in a speech yesterday as the central bank wrestles to get inflation under control, but he didn't rule out the possibility of future rate hikes here.
Given the uncertainties and risks, and given how far we've come, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks.
And joining us now, we've got Yahoo Finance's Jennifer Schonberger. She's joining us now. Jennifer, first, just want to get your impression of what Powell had to say.
Hey, Brad. Yeah, some are saying that Fed Chair Powell signaled that the Fed is finished raising rates. They're going to enter this prolonged pause, but that's not really the impression I got. While the Fed Chair possibly set the table for a pause at the November policy meeting, he very clearly left rate hikes on the table, right? Moving cautiously means moving slowly. It doesn't necessarily mean stopping. And you heard Fed Chair Powell underscore that if this economy continues surprising to the upside, if the job market continues surprising to the upside, then that really risks reigniting inflation and halting the progress we've seen on bringing inflation back down over these past months. This week, we got a strong read on retail sales. Next week, we're going to get a read on third quarter GDP, which is expected to clock in stronger than the second quarter. So with a continued strong job market and large swaths of this economy that are perhaps less interest rate exposed, there's reason to believe that this economy could continue surprising to the upside. And certainly we are starting to hear that from economists now who are looking at more of a soft landing scenario. The big changeover would be JP Morgan, which is no longer expecting recession now.
Yeah, Jen, certainly the resilience here of the economy taking many forecasters by surprise. So we have the latest data points there, but then we also have the fact that we've seen this massive run up in yields, right? You have the 10-year yield right around that 5% level. How do you see that further shaping Fed policy?
Yeah, so there are so many things that can drive bond yields, as you know, Shauna. It can be Fed interest rate policy. It can be the economic outlook. It can be geopolitical reasons. It can be supply, right? We're seeing a lot of treasuries being issued now. We're seeing the Fed engage in QT, rolling those treasuries off its balance sheet. But as we heard from Powell yesterday, he doesn't think a lot of this move up to 5% has been driven by expectations of further Fed rate hikes. Rather, it's about the strength of the economy. Some have said that the yields on the 10-year could be a proxy for economic growth. And I don't know if we're really going to see 5% GDP, but that's point one. Point two is that even though we are seeing yields at 5%, foreboding for potentially above 8% mortgage rates, there are so many people who are sitting on low fixed rate mortgages right now, both baby boomers and otherwise. And they also have jobs. So we know that consumer spending accounts for 70% of this economy. And so long as those factors remain in place, they're going to continue to spend.
All right, Jen, something we are going to continue to watch here. Jen Schonberger, thanks so much.